Thank you so much,
You're an
Sanjiv.
amazing
It's
human being and an amazing stock picker.
always a
Because
total
I think,
pleasure and delight.
concept. Hi viewers, welcome to our 24th edition of FINtastic Talks. And I hope these talks have been adding value to your life and have started you on your journey to building the second income. So, I that is my mission in life. My team calls me the second income guy. And my aim is that, it should encourage everyone to build a second income, which is equivalent, which is at one day going to be support. We should be, be able to take care of him, his family, if that is required. So you have to look at your investments like a business. Your investments are not a pastime, they're not a hobby, but they're a business that you do. And the aim is to create a good corpus, and that corpus should be able to take care and pay for you one day. And that is my mission and vision for which I do these talks, and I hope I am able to add to you. We are in a very interesting time. The markets have started to slide, and there is a lot of talk all over that this dot com bubble, is it about to pop, or has it started to pop? The Nasdaq has seen one of the biggest corrections, and the Indian markets have also reacted very sharply to these corrections that have happened, and especially all the IPOs that had come for these new generation startups have seen a massive correction, and the pricing has gone down. There has been a huge amount of investor wealth that has been eroded. Now, whether this is something which is just like a short blip, or it is something which is going to have a long tail impact, is something that we will be discussing today. And we need to, there is no right answer, there is no wrong answer, because nobody can predict it. If that person could predict it, then that person doesn't need to do anything, he'll be a billionaire. So guys, it's a very interesting time. So because whenever these markets dip, it is not a time to panic, it also gives you an opportunity to buy. So at the end of the day, you have to be patient, you have to be persistent, you need to have a sort of strategy in mind, that what I'll do. And these things can last. We saw during the COVID pandemic, the downturn lasted only 2 months, and then it started going back up. But sometimes these things can last a year, 2 years. So it is impossible to predict how long this will last. But don't get scared, this will bring opportunities, this will bring correction of value, if and this will give you an opportunity to buy and enter the market. And the Indian long term story is still very, very good, and there is a lot of money to be made here in the long run. So guys, without further ado, I am very pleased to invite Jimeet Modi. He started a new mutual fund called SAMCO Mutual Fund, and they've come out with their first fund recently. And so he started a fund late, but he started it with a very unique philosophy. So we are very pleased to have Jimeet. So Jimeet, hello and welcome to the talk. It's great to have you with us today.
Thank you so much, Sanjiv ji. It is an absolute pleasure to be on the same platform with you. It's. I would like to welcome everybody from the Bajaj Capital team and the viewers, who are taking the time out to watch this. And as I said, I hope to add value, as you rightly said earlier at the beginning, for investors to be able to create long-term wealth as a part of this discussion.
Yeah, so Jimmy, this is a very interesting time. Typically I start with a personal introduction, but I think what is happening in the market, I think it will be unfair to everybody who's watching this talk for us not to talk about what is happening in the market. And, for your mutual fund, do you look at it as an opportunity, or you're looking at it as a challenge? Because it is also giving you an opportunity that if this had happened 1 month later, then your initial investments would have happened. Now you'll be investing at the corrected rate. So probably you'll be able to show a better performance.
Yes.
So, what do you feel about this market? What has what is your understanding? You yourself are a big player, operator, and you've been a part of the markets for a long run. So, what is your views of what is happening all around?
So I think what our sense of the market is that there have been certain pockets of excesses that have happened because of in the past few months. As you rightly pointed out in your opening remarks, we've seen a series of newly listed IPOs where fundamentals are typically probably I would say on the moderate to weaker side, but prices were reflecting a very large price to hope multiple, really, if I was to say anything else. But so I think a lot of excesses are getting corrected both in India as well as globally. And for us, we could not be more excited, in the sense that it's good that we've been able to, we close on the 31st of January as far as our NFO is concerned, and things are at least 8 to 10% across the board cheaper for us. So to that extent, a lot more margin of safety from an investment point of view. Obviously we will be deploying capital over the next couple of months, so we will be able to make use of this correction. And for our sake, we hope it continues so that we are able to accumulate stocks at better prices. But I think in general, what has happened is that businesses, because we are in an environment where interest rates are going to go up, and whether it's the Fed, whether it's India, because inflation is sort of roaring across the board. So, and in such an environment, what happens is that typically poor rated businesses, poor quality businesses where fundamentals is low, or where they try and drive a lot more value from futuristic numbers, where terminal value is very high, those kind of businesses will get more beaten down rather than solid long term businesses. And what happens is, as a part of collateral damages, even good businesses end up getting beaten down during correction, and that's where typically our window of opportunity lies. So this and there is no change whatsoever in the long term prospects of any of the businesses that we are looking at, right? So this short term correction only makes it more lucrative for us to buy a lot more of these businesses, and we are fairly excited from that point of view as to what this correction, this correction, this as an opportunity that it gives us.
So, Jimmy, there's been a lot of talk, especially globally, about has the dot-com bust started. So,
Yeah.
what is your view on that?
Yeah, I think our sense is that there are a lot of, in the during the dot com bubble, things were a lot worse. Um, as of today, I think there are some businesses that may not be as bad as the dot com bubble, but yeah, I think there is excess in the system, but it's not probably as bad as the dot com bubble, really. So, I sense is that these extremely futuristic businesses. For them to be able to make return will take probably a long period of time. So I'll give you an example. During the dot-com bubble, even from an Indian context, businesses like Wipro, Infosys, etc., in early 2001, they reached prices, and after which they corrected by 70-80% or so. And it for some businesses like Wipro, it practically took uh, 20 odd years for somebody who bought in at the peak of 2001 to make money, really. So I think it's important to look at a lot of these futuristic businesses, these startup businesses that are being invested in. But I think investors should be mindful of the prices that they are looking at buying at. But because if you end up entering something at a wrong price, it could be well before 5, 8, 10, 15 years before you ever end up making money. So I think it's not as bad as the dot-com bubble. It is there is excess, but I think one needs to be careful as to how and what you typically invest in.
Yeah, so I think it's a very interesting time for all of us, because see, India is still a little bit more cushioned because your private market investments has been very selective, and it's been restricted to mainly HNIs, and very few people who had that enthusiasm have been doing the private market investments. But with the IPOs of these private market companies who are invested in coming in at very high valuations with no logic or no backing, that whether this valuation is justified, and it was just global markets being followed, and there were talks about this company which was valued at more than the whole industry together, and there are so many of such examples. So the point was that the correction there had to start, and that correction has to a certain level has started. Whether it is a true correction or it is just a short term blip and things are going to be back to normal, so that is something that we have to debate. But what has happened is that one, that inflation has gone up, and when inflation goes up, the regulators and the even the reserve banks have to get in to regulate, to control the inflation, because Indian market has seen hyperinflation, but the global market, especially US and Europe, has not seen a hyperinflation. And whenever there is an inflation, there is the difference between the rich and poor increases more drastically. So there the corrective steps need to be taken. So difference between this is that now the corrective steps have been started by the US Fed. The interest rates have gone up, and they have gone up drastically. Like, let me take an example that home loans which were available at 2.5 to 2.75% for a normal person today have gone up to almost 3.75%, 3.5 to even 4%. So that is a 40% increase. ठीक है, so हम Indian aspects से they still sound very cheap यार, we तो pay 6.75 or 7%, but it's like going up from 7% to 10%. That is the impact of this increase. And what happens there is that a lot of people take interest only loans. So when you have an interest only loans, your loan is going up by 30-40%. So it is going to have an impact. And we are at a unique position where all of you need to be more careful. But also, as Jimeet said, good companies remain good companies. And this is the time which gives you an opportunity to buy into good companies. So, Jimeet, you are tracking this more closely. That what, according to you, should the typical investor be doing at this moment? Should he be careful? What exactly is happening in US? How is it playing out in India? And what should an investor be doing today?
See, I think from a long-term point of view, I think investors should not worry too much about the short-term noise that happens around interest rates, inflations, because the reality is that interest rates, inflation as a cycle, interest rates will go up, they will go down over a period of time. I think from a long-term investor point of view, you have to stay the course as far as your asset allocation, as far as your long-term goal is concerned. I mean, if your goal is that you want to get to a certain amount of corpus by the time you're 55, 60, and you've decided that okay, fine, I'm 25, 30, so I need to make sure that my asset allocation is more towards equity because I can take higher risk. I think you've got to stick to that asset allocation. You don't need to worry that. I think it's going to be detrimental if people start taking short-term calls that markets are falling, so let's reduce our equity allocation, or interest rates are going to go up, let's change our debt allocation, so on and so forth. So I think from an investor point of view, stay the course, don't look at it. And I think I'm very big fan of what Steve Jobs has had to say, right? So he always used to say that when there is an environment of complete panic or confusion as to what's going to happen, you've got to zoom out and see what the future holds for you. And I think from a future point of view, when we look back, the current correction will look like a very small blip on a very long-term chart, so it may not even be visible really from a long-term investor point of view. So I don't think we've got to look at that blip and worry about that blip as any change in strategy. So I think idea is that if an investor is looking to make equity allocation, has decided that we are going to invest in equity, debt, or whatever asset class that they have, they should stick the course. If at all they've been sitting on the sidelines, they missed out the rally that has happened in the past two odd years, then in that case they should not typically wait again for a 30-40 kind of a percent. So see, the real challenge is that what investors start thinking is that market has fallen 5%, it will fall 15, 20, 30%. I think instead of worrying about how much and trying to catch that bottom, if you got to invest from a long-term perspective with a 5, 7, 10-year horizon, then go ahead and invest. As I said, this correction is going to look like a small short-term blip. So stay the course, and stick to your plan.
Yeah, so very well answered, Jimit. So before we go further, and I know there are a lot of exciting things we need to talk about today. So before we go exciting, tell us a little bit about yourself, your family, your upbringing, your childhood, and what makes Jimit Jimit. So we would love to understand about you.
Yeah. So I think, see, I have qualified as a rank holder chartered accountant. I was All India rank 9, and I come from a family of chartered accountants. So my father also was a rank holder chartered accountant. So by blood, we are all hardcore equity market guys, hardcore finance and research guys, really. And I also am a CFA by qualification, and grew up in Bombay in a business family. So you know breakfast table conversations to lunch dinner always used to be about stocks. So I started my journey in investing very very early on in my life. So I started when I was like maybe 14 15 years old. And initially, like every new individual in the market, had a lot of beginners luck, so made some money. And then the beginners luck got wiped out, so lost a lot of money. Fortunately, the family wealth did help in as far as sort of paying for some of the losses that happened. So to answer your question, I think what makes me who I am today, it's the fact that over the past 17 18 years, I made so many mistakes in the capital market, and each mistake has typically been what I say, the fee that I paid to the university of the market. And that mistake, every loss that I've made has been the learning curve from an equity market point of view. And I think the reality that these markets, these capital markets, they teach you something every day, and you've got to be a student for life. I think that is what sort of shapes and defines who I am today as an individual, and how I think about the markets, how I think about the long term. And that's a very large part of my personality, really.
Yeah, but here, Jimit, it's a very important point. Is that for a person is to understand that what exactly is a mistake and accept his mistakes. So people say mistakes are a great university, but that also you need to have that humbleness, or to even admit your mistakes. ठीक है, otherwise ego में a lot of people don't admit the mistakes. Till you don't admit the mistakes, then you can't correct them. So also, Jimmy, there is a story I remember you were sharing with me, that how you got a corpus and you have spent the last 10 years growing it. So how did it feel when when you said, "Okay, look, I'm going to be a prop book manager and I'm going to manage my money," and what were the rules and the principles that you followed, and what were the learnings during that time? Because here everybody who's on this talk is a prop book manager of a different size.
Yeah.
Okay, so they would love to understand what were the mistakes you made there, what were your learnings, and what are the right things everybody here can do to make money from doing their own prop book.
Yeah. So I think the biggest learning, from our prop book perspective here, as you said, I mean, when I started investing from our family office, and that book has grown multifold over the past 8 to 10 years. I think the most important aspect was identifying what your edge really is. I think, and what I mean by edge is that, see, you've got to understand and admit that you're not going to make money on every trade, or not, you're not going to make money on every investment that you make. So you need to understand that typically what is your hit rate, how many times do you get it right, when do you get it right, how large can you get it right, how can you maximize your profit, and when you get it wrong, where do you typically put the floor and say, okay, this is enough, I'm going to get out at this particular level. So I think from a investor point of view, any investor, I think it's very important for you to sit down, write down a particular plan, that this is the strategy that I'm following. I am, for my psychology, I am an investor who typically plays long term trends. We are not in the business of buying something cheap, and then trying to see that it'll get repriced, and we'll try and sell it expensive. I think over time I have learned temperamentally that I'm the kind of investor who believes in buying quality, believes in paying a premium for quality, believes in averaging up. I think most people end up making a mistake is that you end up often averaging down. So if you entered an investment at 10, you'll buy more at 8, you'll buy more at 6. I think we've stopped doing that. I think as a philosophy, I'm very clear. We never average down. If I bought something at 10, if I've got to buy more of it, I need to make sure that I'm buying it at 15 or 16 or 17. Averaging up is very important. Getting completely unemotional about investment. I think that's important. Then, we are not, we at the end of the day, our money is working for us. There is no emotional attachment that is involved. We can't rely on hope that, I bought it at something which is at 10 rupees. It's down to 8. I'll wait for it to come back to 10. The market does not know your buying price. So it does not know what price you bought it at, and what price the other investors in the market have bought it at. So you've got to be very unemotional about your approach and learn to cut losses, learn to typically pluck out the weeds from your portfolio from time to time. And as I said, let your winners run. I think that is the hardest thing. People keep saying it time and again on every forum. But I think averaging up, letting your winners run. I think my biggest trade that I would have probably made, I would have bought a particular 10% quantity at $500. Then I would have bought 30% at 800. Then I would have bought another 40 at 1,000 and another 40 at 1,500. And it takes courage for you to buy something at 1,500, which you started buying at 500. I think, but this is a way for the market to tell you that, boss, you were right. You were right that the price has moved to 1,500. So you can keep allocating more capital. Don't get too worried that your first initial buying price was 500. So I will not buy at any initial price, any price above 500 rupees. I think this is a mistake investors often make, that अरे मैंने पहले तो 500 रुपए में खरीदा था, अभी 1000 रुपया होगा, अभी मैं कैसे खरीदूं. I think that is a big learning that people need to adjust. It's very counterintuitive, but once you are able to understand this and start applying this to your investing strategies, I think there is no end to the kind of success that you can taste.
Yeah. So, Jimeet, I think it's very well said that you guys average up. So this is something we don't all understand. And private markets में ये बहुत important होता है. That suppose when you make your first right angel investing, there are a lot of people who are not going to go anywhere. But there are some startups that you will get who will go to a pre-series A, they'll go to a series A, then series B, series C, series D. And you have to understand that these guys are the winners. And I have seen that it's very difficult to average up, because same startup that you invested at a 5 crore valuation is now raising at 50 crores, then it's raising at 150 crores, then it's raising at 500 crores. And you think, yeah, sometimes what is the valuation or what is the... But what I've realized is that when you have got a winning horse, keep backing it. And when you have a losing horse, to putting money behind it is also not the right strategy, but that's what a lot of people do. So, and especially when they are bad stocks, I see a lot of people, yeah, I bought this, it was crashing, then I thought I'll average my price, I put in more, but I've ended up losing 4 times the money because I was trying to average. But Jimeet, here I have to give a practical example. Yesterday only, I hit my, there's a stock I really liked. I think it's going to be a winner. And I did the same thing. It fell down, I averaged, but then it fell down further. And then I had a mental floor. So it reached the floor. Now, for me, I really believe in that stock, but it had gone below my stop loss. So for me, then, it was like my team was calling me up, sir, what to do, tell us. And then I finally decided, stop loss kiya hai, and if I've made a commitment, I will not lose more than an X amount, then it is time for me to hit that stop loss. And I had to book quite a big loss yesterday. But the point is, but then what do you do in this situation when you really believe in a company and that share starts slipping, and these are these are solid, strong companies, then what do you do?
Yeah. So I think the most important thing, Sanjiv, is to segregate trading and investing, and that is one thing that I have learned. If you are a trader, the concept of stop losses, the concept of having a Lakshman Rekha as far as your entry price, etc., is concerned, is really a trading concept. You've got to segregate both. When you're looking at investments, you've got to look at it from a relative basis. I think anchoring that, my buying price was 100 and and keeping a 10% stop loss from an investment would probably be criminal. It would be the right thing to do from a trading point of view. So I think the first and foremost important thing is that you segregate your trading from your investments. If somebody has, let's say, a crore rupees in capital, somebody's decided that I am investing 40-50 lakh rupees from a long-term investment point of view, and I'm using 40-50 lakhs as a trading capital, then segregate that, maintain books separately, and then run. I think from a trading point of view, concept of stop loss is very important, because the reality is that I've seen it in the past. If you don't cut a small loss, it will snowball into a very, very large loss. So it is a very high possibility that if you think that I would have lost 10 rupees, I have seen that people have actually lost all the way to 90 rupees in a 100 rupee investment, because, and what ends up happening is that traders become investors, long-term investors in stocks, even when they were supposed to be traders, and as far as buying is concerned, they do the inverse. They're supposed to be an investor. At a 10 rupee gain, they will exit and they will become traders. So I think that segregation, that this is what I bought from an investment point of view, this is what I bought from a trading point of view, is very different. And I've seen this with some of the largest and the biggest investors. I think some of the biggest investors, even Rakesh ji for that matter, I've heard him over millions of times, and he keeps saying that what he does on his trading and what he does on his investment are completely separate things, and they are maintained separately. They are, the statistics are maintained separately. The rules are separate, and I think very few people can understand and maintain it separately. So temperamentally, as an investor, you got to understand, am I a trader or am I an investor, and then pick one path and stick to that. I think that is what you can do to get away from these practical challenges that you will face on a day-to-day basis. If you are trying to be a bit of both and a trader and an investor, I think picking one between the two is the key to success, really.
I think, and I agree with you. So yeah, what I was sharing was my trading bucket. On my investing bucket, I bought yesterday because I did my asset reallocation. I moved money from debt, which was lying in debt, into equity, and I'm doing my own systematic transfer, because I think there's an opportunity to start buying, especially good stocks. And I personally believe that it's a good time to buy value, and that's what I've been saying for the last 1-2 months, that it's time to put your money into value. These are stronger companies with lower valuation. So I technically, the chances of going down are also lower, but the market has not been pricing them up. So that is also a concern where you have to be careful about. But overall, it's that's the strategy I'm following for myself. And at least I have moved into the market on value and blue chips yesterday, and I think that's going to, but that's my long term sort of a horizon. So Jimit, now we come to Samco Mutual Fund, and I'll take up a question by Madhusudan, which is a very sharp question. He's one of our regular viewers, and he has a habit of asking very nice, very sharp questions. So he's saying, why do we need a new fund and AMC when there are so many out there? And with so many AMCs popping up, investors only end up buying based on rating, performance, and our basket goes big. So, Jimmy, now this question is that a lot of people are going to ask this question, that there are so many AMCs out there. So why another AMC, and how you're going to be different? And let me tell people like Jimit, this is the first question I asked Jimit when I met him. And he gave me an amazing answer to this question. And that's why, we decided that we want to work with Jimit and Samco, and I think he's doing something different. And I'm personally going to be putting in some of my own money in Samco Mutual Fund. So Jimit, but this is a very important question for you to answer to everyone here, that how are you going to be different? How are you not going to be one of many? And how are you going to make that difference in this market?
Yeah. I think thanks, Madhusudan, for your question. I think, as Sanjiv ji said, it's a very important and a sharp question. And see, I think when we started our journey as an AMC, we saw a certain gap, and the whole purpose of setting up an AMC was that we believe that we could do things differently. We could bring a new thought process. We could actually bring a new way of investing that investors, both retail and HNI, have not been able to access. in India. And before I tell you as to what we are intending to do, our assessment of the asset management industry today is that there is a sort of division as far as the industry is concerned. There is one segment that's typically going passive, and then
Jimeet, I'll ask the backend team to take off the question because it's actually taking away a lot of the screen space.
yeah, yeah, yeah. So, see, typically today, our assessment of the asset management industry is that, as you rightly said, there are a lot of AMCs that are typically trying to do the same set of things. And the industry is divided into two. So there is one set of whole passive segment, and the other is an active segment. And one of the big global phenomena that is also now happening in India is index hugging or closet indexing. So, see, most asset managers, what they're trying to do, they're trying to buy the same set of stocks that are there in the index, same set of businesses in 70-80% copy the index, and then after you 70-80% copy the index, if you charge a fee, it's not possible to generate a an alpha or a high risk adjusted return. And so our theory, our thought process is very simple. I think there are two ways of making money over the long term. One is you buy the biggest businesses, and I think the index offers you an option to buy some of the biggest businesses, and the other is you buy only the best businesses in the world. And I think with that mindset, we sort of initiated our whole concept of stress tested investing. So and this is a concept that is not typically applied by any asset manager in India for that matter. And it's a very banking regulatory related concept, right? Where where banks typically are put through series of stress tests to evaluate whether they would survive downturns, economic shocks, so on and so forth. And we are trying to do the same from an investment point of view. So we apply a 6-faceted framework that we have, which we call our hexagonal framework. We apply it to every listed business in the world, and we try and stress test that for two things: can a business survive or not? And secondly, can a business generate a high risk adjusted return by being a true compounding machine? So today, out of 67,000 companies globally, only 125 companies pass our stress tests. Of 40 odd names are Indian companies, 85 odd companies are global companies, from across the United States, Europe, Asia Pacific, so on and so forth. And as an AMC, we are very clear. We don't want to be a Me Too AMC. We will only invest in these 125 names, unlike other businesses which typically have investments in anywhere between 4 to 500 stocks across the board. So our aim is very clear: to offer exposure to only the best, most efficient stress tested businesses with some of our funds. And which is why we've sort of stuck our neck out and said we'll never do a PSU fund, we'll never do an infra fund, we'll never do a power or an energy fund for that matter. We will stick to these sort of limited stress tested funds that can compound in value. And at the same time, I think what we are also pioneering is a concept called active share, which means that how different is the portfolio. Today, most asset managers typically have a very small differentiated portfolio, 30-35% difference. Our philosophy is very clear that we will have a fund that is at least 75-80% different from the index. Because, sir, the reality is, Madhusudan, if you're an investor, you're paying an asset management fee, are you getting something that is truly different or not? Which is measured by active share. So active share was a measure that was designed by two Yale professors, Kremers and Perejitso, in 2009. And that's a concept that we are bringing to India that has not been discussed ever in the past. So, these are some of the new things that we're trying to do with our investment process, offering some 125 of the best names in some of our portfolios that we will launch today and in the future, and have truly differentiated portfolios.
Yeah, so I think that's quite interesting. So, Jimeet, you have made a lot of very strong statements that we are not going to be a Me Too. We are not just going to be creating funds for the sake of creating funds. But I'm very excited about these, the corpus of these 120 winning companies that you have created, and you'll be actively investing. And another thing I liked was that whereas a lot of the Indian funds which are giving you a global exposure are restricting themselves to 10, 15, 20 stocks, where for you this large part of your this stock bucket is these international companies that you think are very well managed, governed, and they have a good chance of winning. So just tell us a little bit more about what is the exact number of companies, how many of them are Indian, how many of them are global, a bit about those companies, and why should an Indian investor have those companies in his portfolio?
Yeah. See, I think out of the entire universe of 125 names that we have, about 40 odd companies are Indian, 85 odd are global. And I think the first and foremost important thing is as to why should an Indian investor have global exposure, right? And the answer really lies is that why should an Indian investor restrict himself to making money only from businesses that are listed in India, right? So, and a very famous example that I often give is that, if you invested 5 years ago in TCS, right, which is one of the largest Indian businesses out there. TCS used to be about a $80 billion company. Now it's become a $200 billion odd company. So 1 rupee invested in TCS has gone to 2.5. Now, at the same time, if you would have invested in Microsoft, now all of us know Microsoft, all of us use Word, Excel, PowerPoint. 1 rupee invested in Microsoft has grown to 6 rupees. So a $400 billion company actually has gone to $2.4 trillion in value. Now, as an investor, why should we be restricted to not benefiting from the long-term trends that, or the long-term growth prospects that Microsoft offers? So that's first. I think it's truly important for us to be global investors. Let's not pigeonhole ourselves that we will only make money by only investing in businesses that are restricted to the Indian geography. Really, I think the world is becoming more and more flat, and we should look for opportunities across the world. And I think out of the 85 companies that we look at, we have 30 odd US businesses, which are a lot of large tech plays that are available in the United States. We have a few European companies that are both large manufacturing businesses or large brand businesses, consumer brands based businesses in the Europe. We also have a lot of Japanese businesses which are again a lot of technology, both hardware, software, technology set of businesses. And see, the idea is that these global businesses offer us an opportunity to participate in trends that otherwise that would not be available from an Indian point of view. Now, let me give you an example of the metaverse, right? I think the metaverse or the Web3 is assumed to be the next big trend that's playing out. Now, if we had to buy and play any Indian business that is a play on that trend, I think we would not be able to do so. But we have a set of global businesses like the Meta platforms, which is Facebook, Nvidia, which is a global AI chip manufacturing company, in fact Microsoft, and as well, which bought Activation Blizzard as well. So these are businesses that allow us to participate in these trends, these long-term trends that are global trends playing out, which is not possible only if you are invested in from an Indian geography point of view. So this is the broad mix. I think 30-35 US names, 25-30 European names, about 15 odd Asian names, and these are from Japan and Asia Pacific, really. And these are opportunities that come across sectors. So technology, pharmaceutical. In fact, to give you an example, one of the biggest pharmaceutical plays that is a stress tested company is a company called Novo Nordisk. They are the world's largest manufacturers of insulin pens, and they spend about 10% of their annual sales on R&D. Now, it's unheard of for an Indian company to spend such a large amount on R&D. So you get exposure as an Indian investor to such businesses which are market leaders, having a very high return on capital employed, reinvesting at a high rate, aggressively investing in R&D, building new products and services. And as Indian investors, we get to participate in these growth stories. I think that is the biggest opportunity for us, really.
Yeah, so I think Jimeet very well answered, and I hope you have answered everyone's question. Guys, this is not going to be a Me Too fund. It is going to be a totally unique fund where they are going to be investing in these 120 companies. And about a significant majority of these companies, about 50-60%, are going to be global companies, because today we are living in a global economy. And those of you who have been hearing these talks, there is always a talk of 10, 15, 20% portfolio building a global portfolio as per your allocation. But it is very, very important for you to do that, because today those companies are operating in India. So like a Microsoft is doing huge amount of business in India, so is Amazon, so is others. So if you believe they are going to take away business from India, then why should you not be invested in them? So they are, so Samco is going to be invested in these 100 companies. So he's coming up with a very, unique perspective. Now, whether this will work or not work, only time will tell. But, on the, but our thing is that, and this is a mistake most of the people make, is that they go on the past performance. That past performance means the story is already over. And to make money in the market, you have to invest in a concept or an ideology that sounds good. And those are the people who make money. So, for me, Jimeet's ideology seems good. So I am going to definitely put a part of my allocation into that, because it's him doing something different, something new, something unique. And Jimeet, we are quite bullish that when we hope that your NFO does well. There's a question by Anil Chopra. He's asking, is there any attractive IPO in the next quarter or couple of months? Mr. Chopra, we generally don't talk about specific IPOs, but I'm sure Jimeet will say his NFO is good and you should give it some allocation. And but your next question is very relevant, and we are actually doing a special edition of FINtastic Talk this Saturday to talk about the budget and what to expect and how it is going to impact the market. So, Jimit, would you like to say something on this question, that are we expecting any significant announcements in the budget which could affect the markets positively? What has been affecting the markets negatively is the talk about increasing the capital gains to 15%. But what are the positives and the negatives that are expected in this budget announcement?
Yeah. So, I mean, obviously, no one knows what's going to come in the budget. But if I was to take a slightly commonsensical approach to this, my assessment is that LIC IPO is coming in the month of March, and the government would not do anything to disappoint the markets, because typically they are going to take away between 75,000 crores to 1 lakh crores from the markets with the LIC IPO, really. So, in fact, I don't expect any such noise on the negative, any negatives to come in from increase of long-term capital gains. I think none of that is going to happen. In fact, if at all, the government will undertake a very long, investment program. I think last year they sort of set the trend that we want to incur a lot more expenditure, both on the capex as well as on the revenue front. And I think that is what the government will also come and say in a thumping manner, that we are investing for growth. And we are investing by way of various schemes for promoting manufacturing, for promoting growth of businesses in India. And I think that is what will sort of surprise the market positively, because every time there is negative talk about market, there would be long-term capital gain tax, etc., increases. But I don't think this time it's happening with the LIC IPO just in the offing. So I think we will expect a positive budget. The government wants the markets to be very happy. Otherwise, it would be very difficult to mop up the 75,000 or the lakh crore that the government wants to mop up. So I think no negative news, maybe partially positive or maybe excitingly positive. I think that typically is where we see the budget going.
Very well answered. And this is my, I will answer this question more in detail on Saturday. But my view is also very similar, although there is a active threat of that, that increase happening of 15%. But that will be very unfortunate, because, from 0% to 10% to 15%, if it's done. And this is something that where in markets have been actually supporting almost the whole economy, and the whole feel India factor and the good factor is feel good factor is coming from here. And if we make these investment, this sector unattractive or less attractive, then we will, it will really affect the FDIs and the money coming into India. So we hope this doesn't happen. On the other side, I agree with Jimmy. There should be a lot of positive announcements. I am expecting this to be a high spend budget, because last time a lot of announcements were done, but the money has not been spent. So I think a lot of more announcements, and plus make in India is going to get a huge push and should get a huge push, because that's the winning strategy for India, because it will create jobs, it will create sort of a moat for India in the global economy. And with the anti-China sentiment, and if this is not done now, it will never get done. So I think it's all good in the long run, nothing to worry about. What is happening at the moment is a reaction to the international markets and a little bit of correction that is required. So, nothing to worry about. If you want to enter the market, I would say avoid lump sum, or go in through a balance advantage fund route, or you can do a systematic transfer plan into the market, or just do your own asset allocation on your own. So there's a very interesting question by Jimeet, by Murali, very basic but very interesting. What should be the investment strategy for 2022? So, I think thanks, Murali, for asking this very relevant question. So, Jimit, what would you like to say on this?
I mean, I've got a slightly different view in the sense that, I mean, you don't have an investor strategy just for one calendar year. You typically have an investment strategy that, I mean, 2022 is just one another year in typically the investment horizon for years. And our sense is that, we are equity investors. We take a 5 to 7 year view every time we make an investment, every time we underwrite an investment. And we are actually embracing this correction that is happening as far as the markets are concerned, and using this correction to benefit and buy solid good businesses that we've always had an eye on, which typically where there was a short run up, now this correction offers an opportunity. And it's very silly to expect that markets will keep going up every day, right? I think it is the downside volatility that gives us the opportunity, really. So I think, Murali, I don't think about investment from a singular year point of view. I think at the beginning, as I said, think about it as a plan. Decide what you want to do from your investments. 1 year has no relevance from an investing point of view. I think, understand that 1 year is a concept that is applicable in astronomy. It is the amount of time that the earth takes to rotate around the sun. It has got no relevance in investing as a business cycle at all. So I think when you think about investing, you got to take a longer term view across cycles, and there are typically 3 cycles: a bull, bear, and a flattish kind of a cycle. And we as a country are in a multi-year bull run. So there will be blips, there will be corrections from time to time, but in general, I think a good plan or a good investment strategy would be for investments for money that you can invest for 5 to 7 years, make an equity allocation. For money that you may need from a 12 to 18, 24-month kind of view, make shorter term, make investments in either hybrid funds or in conservative hybrid funds, or in longer duration, medium duration, and for money that you will need typically from a liquidity perspective, park that money, keep that money in cash, or keep it liquid. I think that's how you should design your asset allocation and allocate money as far as your investments are concerned.
Yeah, so I think Jimit very well answered to Murali. Murali, asset allocation is not for 1 year. This is for long term. And yes, this needs to be updated every 5 years, 10 years, or when there is a significant impact. I'll give you my own example. My asset allocation typically I follow is about right now is that, private markets have come in. So today, almost 20% of my wealth I'm actually putting in private markets. And then about 40% in, I do equities. And then another 40% in real estate and debt. Now, point is that, for me, I've changed my asset allocation by putting private markets in. When the markets have fallen down, I have put in more money into markets because my debt allocation had gone up. So I actually moved money to balance it. And the way I do personally change is that I am now going to increase my allocation to property, which I've done last year. On the paper is that I believe that real estate has had a 10-year of downturn. So it may have a upside there. And this may be a good opportunity with the corrected prices, although prices have gone up to buy. So, I personally have increased my allocation to property by 10%. So, so you have to take a call, but these are all long-term things. Another, I'm quite excited to see a lot of people from various colleges and school today. Wellinger Institute, V School, and a lot of different people. Welcome the youngsters, and very excited to seeing all of you here. And this is the way for you to build your foundation. It's time for you to invest and to be tomorrow's wealth managers and financial analysts. This is one of the most exciting industries we can be in. So then other is a next question I want to take is from Madhusudan Bhandarkar. He's asking, will the state elections have an impact of the market, or there are too many elections happening? And that's my view personally, that it doesn't truly impact the market. So how would you answer Madhusudan's question?
I think, as you said, it doesn't matter. We have 29, 30 states in the country. Every 5 years, every second month, a state will go for state election. So I think from short to if at all there will be some geographical impact on certain businesses that are particularly extremely dependent on A or B particular state. But in general, from a market point of view, it doesn't really matter.
And I think he's asking a question, purchasing penny stocks is very risky. Yes, market is one thing, where the cheaper the stock is, the riskier it is. So, Jimit, you want to add something?
I think there is one Hindi saying that I was taught early. I mean, as a part of the mistakes that I made was obviously buying penny stocks, and I learned the hard way that you shouldn't do that. And then after that, my mother said, "Sasta roye 100 bar, महंगा roye एक बार." So if you try and buy something which is a penny stock, which is cheap, please understand it is cheap for a reason. It is because there is practically nothing in the business. This is just story, just pump and dump. So please avoid purchasing any penny stocks for that matter. They could actually end up destroying your entire wealth. I've seen people making mistakes with penny stocks, and the problem is that when things go south for penny stocks, there is no exit available. Even if you have 100 shares, you will not be able to sell 100 shares as well, because there would be a series of 20, 30 down circuits, and there would be a complete destruction of value. Instead, I think it's better to, if you're investing in direct stocks, please invest in high good quality businesses where you can typically invest at a reasonable price, and then let compounding happen in due course. And if at all you don't intend to invest in stocks directly, please go ahead and give money to an asset manager who will manage the money for you. But I think please stay away from penny stocks. They would typically they could destroy your entire wealth.
Yeah, I think there's a question we have already answered, whether SAMCO believes in passive or active investing. Guys, SAMCO is all about active investing and very active investing. Mr. MP Jain has asked a question that, I'm sure SAMCO aspires to be another Parag Parikh in terms of performance. But what is going to be the allocation between the Indian equity and foreign equity? Mr. MP Jain is asking this question.
Yeah. So I think as a part of our scheme information document, our steady state allocation will be 65-35 between Indian equity and global equity. There would be obviously some basis point movement up and down depending on how the Indian markets perform or how the global markets perform. But yeah, I think that's a steady state allocation that we will be looking at. And that will make sure that it is an Indian equity fund from a taxation point of view. It remains a fund which will have 1 year long-term capital gain taxation. So as far as about of our 25 stock portfolio, so we may have about 15, 16 Indian names, 9 to 10 global names that will be a part of the portfolio. So that will be broadly the steady state allocation from an investment point of view. And I think one of the ways we are sort of differentiating from other funds is the fact that we are typically growth investors. We believe in buying businesses that can grow and compound capital over a long period of time with a very high incremental return on reinvestment. And typically, this probably, our fund with the SAMCO Flexi Cap Fund is one of the only funds which has like a 65-35 allocation with a growth strategy. We, unlike others, we don't intend to run it as a value strategy. As I said earlier, we believe that you have to buy great businesses. You've got to pay some premium for it and let the markets do the job of compounding it in value. So, that's typically as far as how our allocation between India and global will work.
Yeah. So there's a very interesting question by Hitesh Sharma. He's saying that we can only believe on trust or trust someone companies based on past performance. Then how can that approach be a mistake? So Hitesh, I'll put in my 2 words here. See, past performance is a past performance. It's not the future. And companies which have to stay relevant today, because we are living in a very fast changing world. So if we don't change with times, we become irrelevant. I'm taking a very strong example. Look at a Microsoft. The Microsoft has got repriced, and as Jimit was saying, 6 times the valuation has gone up because the work they have done in cloud and Azure, and how they are now, very future ready and doing. And same way with Adobe, the amount of investment Adobe did and the kind of successes they have got on marketing cloud and a lot of those other tools they have created is why they are being valued. Whereas there are other companies like Intel and Oracle, which are not seen as that progressive, are being devalued, although they were at one time fantastic companies. So point is, buddy, if you want to make money, you have to play the future. Past is a past. It may, generally there is a rule that what was good will remain good. And that's why that's why past performance has still worked, because generally good remain good, and for a good to become bad is a less of a chance. But the point is, but if you want to spot the winners, you want to get crazy returns, you want to get big winners, then you have to start looking at the future also. So Jimit, what would you add here?
See, I think, I typically give an analogy from a stock market perspective for when I face such a question. See, if you identify to invest in a stock at 100 rupees and you believe that it has great future prospects. Now, if you identified it at 100, will you wait for it to perform and go to 120 before you buy or not? I mean, typically, when we say we rely on past performance, you want a stock to move from 100 to 120, and then you would buy. I think this is exactly the opposite that we do in stocks, right? When we've identified a stock at 100, if it falls, we typically end up buying more or investing in it more. We don't wait for it to increase by 15-20% and then invest, and we wait for performance to come in and then invest. So, as you rightly said, bang on, investing is about future. Investing is about understanding the current prospects. You are paying the price for a particular business at today's current market price. And if you believe that yes, long-term prospects are great, the business is doing all the right things in order to create value for you, whether you buy it at 100 or you buy it after it has performed or more. In fact, after it has performed, if you end up buying, actually you are buying it at a lower margin of safety, really. So I think that is, a couple of thoughts that I would like to add to one wonderful response that you've already given, Sanjiv.
Yeah. And somebody is asking, am I promoting SIPs? I always promote SIPs, because that's one of the most easiest and convenient ways of entering into the market. And if you want to do SAMCO, you should look at a SIP option also. There's nothing wrong with it. There's a gentle question by Mr. SR. He's asking, what is the launch date of SAMCO Flexi Fund, and how much is the minimum and maximum investment? And then there's another question by Mr. Mahinder Kumar Gupta. What is the expense ratio of SAMCO Flexi Cap? Here, I'll just quickly say this is a proper mutual fund. So it is as per the mutual fund regulations. The expenses is also as per the mutual fund regulations, and Indian expense rates are amongst the best in the world. even on the distributor-led schemes. So they are actually very good. So, but I will let Jimit answer this question.
Yeah. So the NFO of the scheme opened on 17th of January, and the NFO will close on the 31st of January, which is next Monday. The minimum application amount in the lump sum route is 5,000 rupees. The minimum application amount in the SIP route is 500 rupees. So if you want to make a lump sum investment, those are 5,000 is the limit. SIP 500 rupees is the limit that you can look for. And see, as Sanjeev ji said, the expense ratios is very well regulated by SEBI. We will typically, our aim is that over the medium to long term, our expense ratio will be in the range of 1.8 to 1.9% in the regular plan. I think that's where we will end up being typically. I think one important aspect which we typically say, and one more concept that we are pioneering at SAMCO is we intend to keep a low total cost of investment. See, today, mutual fund investors believe that TER or the total expense ratio is the only cost that they are paying. But that is not the truth. In fact, see, every time when fund managers make churning in the portfolio, they buy and sell stocks, they incur brokerage, STT, GST, etc. As a part of the trading that they do. And that adds to cost. That is over and above the TER that is not reported. There is something called as a voluntary dealing cost. So our goal at SAMCO is that we will maintain, with our strategy of buying 25 great businesses at a reasonable price, we will maintain very low portfolio turnover. And because of maintaining a low portfolio turnover, our voluntary dealing cost will be low, very low, in the range of 0.05 to 0.10%. And our goal is to therefore be one of the funds with the lowest total cost of investment, so that once the total cost is lower, I think investor returns can get added to by virtue of cost savings on the dealing side. So I think that is one more the disclosures on voluntary dealing cost is one more initiative that we are leading at SAMCO.
Yeah, very well answered. So Ashok ji has asked a question that please enlighten on private market. Sorry, I have been using the lingos. Private market means these are companies which are startup investing. These are companies which are not listed on the stock market as yet. These are companies which are going to come out with future NFOs, or these are unlisted securities. These are very high risk and very long term. And you should only do it, if you are a risk seeker like me, and you're looking at very high returns. But then the chances of, if you make 10 investments, you may go wrong on 4-5 investments. You may go right on 5 investments, which give you a lot of very good returns. So these are very high risk instruments, but that only a very informed and a passionate investor should look at. But it is an exciting class. One of the easier way of doing it is that today you have AIFs and venture funds. You can invest through that. But that there you require, being an AIF, you require minimum 1 crore of allocation there. And we have one last question we can take. So there's a lot of excitement about your SAMCO mutual fund, Jimeet, and a lot of people are looking to invest. So if you need any help, you can please put in comments, and we'll make sure our team answers every question and provides you all the help that is required. But one final question, which is very relevant: what is the impact between GDP growth and stock market? Saurabh Soni is asking that question. What is the relationship between GDP growth and stock market?
I think if you see long-term correlation, there is no correlation between GDP growth and the stock market, because there have been years where GDP has been 8-9% positive and the markets have actually gone down. And the inverse has also happened, where if you see last year itself, 2020-21, where because of COVID, GDP was actually as a whole year was negative or in the single digit numbers. But still the markets went up phenomenally well from the March 2020 lows. So I think, there is no short-term correlation as far as the GDP and the stock markets are concerned. I think over the longer term, what matters is that as far as the markets are concerned, and when you look at indices, you look at the fact that as the general level of activity of the business of the economy goes up, which is represented by the GDP, some of the businesses that are listed on the exchanges, will do really, really well. They will end up earning a lot more money over a period of time. And as they keep compounding as their earnings, as they keep growing their earnings, even if multiples remain the same, the stock markets will be at a lot higher levels than they are currently. So to answer your question simply, in the short term, there is no relationship between the GDP and the in the markets on a direct proportion basis. But I think over the long term, the growth of the GDP and the growth of the markets will sort of catch up with each other as underlying businesses grow and contribute and end up having earnings coming in.
Yeah, so I think that's a very good answer. So, guys, GDP and stock market may not have a correlation, but a growth of a company and its stock price does have a correlation. So, so because GDP growth has a lot of other factors, so you have to look at the growth rate of a company. If a company is growing fast, then and it's a good company, then its valuation will go up. So, I thank you, Jimeet, for taking out time today, and thank you everybody who took out time to attend. We are very excited about SAMCO Mutual Fund and our best wishes. And we do hope that you replicate the Parag Parekh story and do even better. So our best wishes and blessings. Any last words, Jimeet, before we close today's session?
No, I think thank you so much, Sanjiv ji, for your kind words and your blessings. And with those blessings, I would highly encourage and investors to have a serious look at the Samco Flexi Cap Fund, look at allocating capital, and allow us the opportunity to create long-term wealth for you. We can't give any assured returns, but the only thing that we can promise is that we will manage investor money with the highest level of transparency, integrity, and honesty. And I think that is what will over the long term allow us to create a lot of wealth for investors. So do be a part of our growth journey as Samco, along with Bajaj Capital, and in your personal wealth creation journey.
Yeah. Thank you, Jimeet, and thank you everyone for taking out time. Please keep coming, and we hope we are helping you create wealth. Thank you, everyone.